Hey, welcome into another episode of the Fearless Investor Podcast. And we're doing the side segment here with Chris Miles on the Chris Miles Money Minute. We do this every single month, last Thursday of the month, except for like a month like this where it is Christmas time. And so we're bringing you a little bit earlier for this episode. But happy holidays to everyone. And let's talk about, ways to put more money in the bank account before Christmas so that we can afford some of those gifts for our loved ones. And that's exactly what we're always talking about every single month with Chris Miles. And before we jump into it, I want to remind you, go to fearlesskyle.com/Chris Miles. Okay, this is one of the best minds of investing of our time, and you can talk to him for free for 15 minutes on a free consultation. He's going to look at what you've got going on in your life financially and what your goals are, and being able to, like we always talk about, Chris, get you to retirement earlier, or quote unquote retirement, because we never want to retire, right? Hey, fearlesskyle.com/Chris Miles. You can get connected with him and you can talk to him more about what we're talking about today. But hey, welcome to the show, Chris.
Thanks. Got my Christmas money green on right now,
I love it. I love it. Well, hey, we were kind of talking about it before we got on the show here, and it seemed like, people want to know more about infinite banking based on just all the stuff that we're seeing. A lot of people were watching and listening and engaging when it came to infinite banking. And whenever I talk to people about it, it's so foreign to them, and I'm still learning about it too. But there's this thing out there, and there's these people out there that maybe misrepresent infinite banking as well. And honestly, there ends up being a lot wrong with infinite banking because of that. So let's kind of take the devil's advocate side on all of this and talk about the other side of infinite banking today.
Yeah, I mean, this kind of got inspired because I had a guy that reached out to me. He also went down the YouTube rabbit hole to get to like our videos and stuff, right? And he's like, Chris, like it's so hard because I start watching all these videos and I'm getting analysis paralysis, right? Because they say this and they say this and somebody else says this and then you say this, Chris. And he's like, I feel like I can trust you, but how do I know where to turn? Like, how do I know what to trust? So let's talk about a few of those myths, right? Like there's a lot of myths in the infinite banking world that actually is not true.
Okay.
And this is what makes it untrustworthy for a lot of people, right? Because it's like half truths and it's all a sales pitch. And I had to tell this guy, he's like, I know that he's like, Chris, I know you make yours like max ROI and you cut your commissions down big time, but I know you're still trying to make money. I'm like, dude, I'm the only guy that you'll listen to on these YouTube videos that's actually financially free, not from doing the insurance sales. Like
Right.
I'm financially free from my real estate and from other investments and things I have as passive income coming in. I don't even need the money.
Right.
But it came out of retirement because this kind of stuff ticks me off, right? I get so mad that people are freaking like teaching stuff about infinite banking and it doesn't work. So let me give you an example,
Okay.
right? One, he asked me, he said, Chris, like, I'm trying to figure out, should I put money in my Roth IRA or my 401k, or should I put money in life insurance, or should I do all of them? And I said, first off, do you want to retire, have a chance of retirement, a chance of financial freedom, or do you want 100% of no financial freedom, like 100% chance of no financial freedom? He's like, obviously, I want a chance.
Right.
And this guy's only in his mid 30s, right?
Okay.
He's like, I want a chance. I'm like, well, if you want a 100% chance of not becoming financially free, fund your 401k, fund your Roth IRA, and only fund your life insurance. Like if you just do those things, including the life insurance, you will never become financially free. I guarantee it. There's a reason why insurance companies will say supplemental retirement, right? You cannot retire off of whole life by itself.
Okay.
This is why you need things like real estate. You can't do it without alternative investments, right? So that's number one. Like when people say, hey, this could be your retirement, and hey, it might be the stock market. He's like, well, should the stock market be their whole life? I'm like, most likely it might. It actually might be the life insurance. But here's the thing. Neither of them will get you where you want to go. So why keep funding that crap like that? Like that's not your path. Your path needs to be, what's the vehicle you use that allows you to invest in these other things? You can't easily do it with the 401ks or IRAs or Roths. The best way to do it is through life insurance, where it gives you that flexibility to retire before you're 59 and a half. So that's number one, is you cannot retire off.
So really quick, I just want to kind of evaluate that. What you're saying is, if I am looking at whole life insurance, and that's what we're talking about today is infinite banking. The vehicle there is whole life insurance.
Yeah.
If I'm just funding it and I'm not doing any sort of investments through it, using that symbiotic relationship that investment needs to have with the whole life insurance policy, then that's not going to get me to retirement. Is that what you're saying?
Exactly.
Okay.
Exactly.
Cool.
Yep.
All right. Number two.
So number two, I hate it when they say you pay yourself back, right? You pay yourself interest. False. You pay the insurance company interest just like you do any other bank.
Yep.
Now, the difference is the insurance company is also paying you interest at the same time, which is the cool part, right?
Yep.
But don't believe for 1 minute that you're just paying yourself back interest, because that's just a sales pitch, right? They charge you like 5%. You might be earning 5+% on that money, right? But they are charging you 5%, pure real interest. So that's another one. That's number two.
So, and I want to stop there too. Sorry, I'm not
Yeah.
going to interrupt you too much, but I want to make sure if people are watching this for the first time, they understand that. So and I love this basically comparison. It's if you have $100,000 in your life insurance policy and you need $50,000, say, to put a down payment on a home.
Yeah.
You take out that 50,000, you're getting charged 5% ish interest on that 50,000, but you're still earning 5% on the 100,000. You're not losing out on what you take out. It's basically a line of credit that you're taking out. So that's the beautiful thing about it. That helps you to keep on earning. And honestly, if you do the math on that, you're still coming out way ahead. Even if you are paying 5% on what you're loaning from your whole life insurance policy.
Right. I mean, imagine having a home equity line of credit that also paid you interest. And then if you made money with it investing, then you're making interest again. You're double dipping, right?
Yep.
That's the cool part. That's why I love using this as infinite banking. But that leads to number three, right? The big one that everybody talks about is dividends. Like, what are the dividends? And is it, have you guys been deep enough in this rabbit hole? You hear about non-direct versus direct recognition companies, all that kind of stuff, right? All that stuff. Dividends, direct versus non-direct, smokescreen.
Mm-hmm.
Complete smokescreen. It's irrelevant. So let me explain why. Like, I remember there's a company I used to write with more often than I do now. The last 4 years, I haven't really written with them. I use them because they would beat other companies with higher dividends. In fact, their dividend rate was 1%. 1% dividend rate that they would promise for the first 10 years. It was just flat 1%. That's all you got, right?
Okay.
But other companies were paying 7 or 8% at the time. Well, how did they win? How would they be able to beat them? Understand that whole life policies, and not even every company. So not all companies are creating and doing their policies the same, right? Secondly, not even every agent's doing their policies the same. So you could have the same company. I've actually done comparisons where I've shown a Penn Mutual policy, for example, and did my Penn Mutual policy and beat the other agent, because it's all about design, right? It's about the cost. How much can you minimize the cost? Because I tell people, it's like, even though they only paid 1%, here's the thing. If they're 10% less on costs, I guarantee that those companies won't be trying to pay 11, 12% a year in dividends to beat that 1%, because again, they have 10% higher costs. They got to lower them to be equal, but companies don't do that. So sometimes they'll even say, hey, I'll boost up the dividend rate. Hey, we'll promise, right now, a good return is 6%. A good dividend rate is 6%, right? Hey, we'll pay 6.5. Well, you know what they do? They just increase the cost of the insurance to make up for it, to pay for the dividend,
Do you have an example of some hard numbers for that, just to give a little bit more of a visual there?
Yeah. I should have did a share screen or something like that.
No, you're good. You're good.
But like I said, like that 1%, right? That 1% dividend. I was comparing that to another company that was paying 7%, right?
Mm-hmm.
It still produced like at least 0.5% more net return on that money, all because again the costs were less, right? Another example is, like I have I work with two different companies, two big ones, right? Mass Mutual is a big one, and Penn Mutual are a big one. Now their dividend rates are right about 0.25% apart. So Mass Mutual pays 0.25% more than Penn Mutual, but because Mass doesn't let me cut down the costs as much, Penn Mutual will beat them every time. And so what do people do? Like now you'll see people on YouTube trashing on Penn Mutual saying, yeah, but do they really pay that well? History says this. I'm like, dude, I've seen the history. Your numbers went down too. Like
Right.
From what it was 15 years ago, all dividends came down. In fact, Penn Mutual it was closer to the numbers than your company was, right? And again, I'm independently brokered. And so that's why I kind of see through all the crap, because every company that tries to pitch on why their company's the best and why I should sell more with them, they're all trying to pitch some little unique thing like, oh, well, we pay higher dividend, or hey, we offer this, or we offer that, or we're just big. We're a really big company, so you should trust us, right? It's like, yeah, you're big with big expenses, and that's why my clients lose, right? So it's always about how much can you reduce the costs of that insurance to allow the cash inside of it to grow faster. Dividends are they help a little bit, but they're basically way more irrelevant than what people say they are.
Okay, so cost over dividends, 100% when it
Mhm.
comes to this infinite banking stuff. Now, when you hear someone say whole life insurance is a scam, and I'm sure you know some
Uh-huh.
people that say that, what do you say to that?
It could be,
Yeah,
depending on how it's set up, right?
yeah,
Like people say, Dave Ramsey says it's a waste of money. I'm like,
mm,
you know what? Depending on how it's again designed, right?
right.
How the agent designs it, and just so you know, insurance companies don't train their agents how to design it this way that I'm talking about, right? That doesn't happen. It's not in their best interest. The companies actually would lose money. They make more money just telling agents to do the status quo.
Sure.
There is where the bad reputation comes for whole life insurance specifically, right? That's why they say, don't put money in there. You make hardly nothing because it's true. The traditional whole life policy, you pay premiums in for 15, 17 years to where you finally break even on your costs. So
Mm,
what I mean is this, say you're putting in 10,000 a year for 15 years, that's 150,000. You hope and pray if you did a traditional whole life plan to have 150,000 in cash after 15 years.
that's crazy. Yeah.
Now, Kyle, you already know because we've ran numbers for like your situation, right? We try to do that in 5,
Yep.
not 15 or 17 years, right? Again, it's about the cost and the design. So when people say it's a scam, I'm like, well, depending on who you're listening to and what their perspective is, they could be right. And
Mm,
even if it's an infinite banker, that's the thing is that I was sold in 2006 on the infinite banking concept, right? But it was always taught to me, hey, well, this takes 15, 17 years before you break even. After 5, 10 years, you might finally be able to buy a car with it, and they tell you to buy cars.
yeah.
Oh, another myth. Do not buy cars or houses, like actually doing that instead of mortgages or paying off cars or houses with your life insurance.
Really? So I've heard that a lot. Why do you not want to
Yeah.
do that?
It's like what you said earlier, right? It's just a line of credit.
Mhm.
You're getting a line of credit. Now, imagine this. Say you can get a car loan at 3% with the bank, or I can use the money for my life insurance and borrow at 5% from that bank, right? Which is also called an insurance company.
Right.
Um, 5% versus 3%. What would you rather pay, Kyle?
3%.
3%, right?
Yeah.
That's my point. Like, so if I can get a mortgage at 3, 4%, that beats 5. Now, there might be some exceptions, right? Now, credit cards, yes, no brainer, right?
Sure.
But when I try to do this, especially with real estate investing, I don't try to buy it all in cash and finance it myself, right? Again, that's a sales pitch from insurance people to say, dump as much money as you can into these things so then you can go and create your own bank. Well, personally, I want to get as much bank money as possible that's cheap. And then what I cannot get bank money for, like a down payment on a property, then that's when I use life insurance for that
Okay.
to pay the down payment. So
And then you
big
just take
difference.
the cash flow to pay back your life insurance.
Exactly.
Okay.
Yep.
There you go. See, I mean, that's something that literally everyone that I talk to about, infinite banking, they're like, oh yeah, when you go buy a car, you just, instead of going through the bank, you do it. And I'm like, and so I'm glad you brought that up. That's really
Mhm.
good information. All right. So the lesson here is that there's a lot of ways that infinite banking and whole life insurance policies can be done wrong. So you need to
Right.
have the right person on your side. Guys, you need to go to fearlesskyle.com/Chris Miles if you're serious about getting started. I realize you probably have family members and friends of friends that, are doing life insurance and, swear that they're the best person. But guys, you got the best person right here that you're listening to and watching that is doing it. And like Chris said, he's financially free already. He is not trying to make a buck off you guys. He's trying to help you get set up with the right policy for you because he came out of retirement because he was tired about hearing people doing this the wrong way. So again, fearlesskyle.com/Chris Miles. Thanks for joining us today on the Chris Miles Money Minute. Chris, thanks so much for being on and just helping us to continue to conquer investing and, and everything infinite banking out there. Thank you so much.